Hey dudes and duderinas, this is the Finance Dude. In my presentation video, I mentioned a method that allows me to thoroughly analyze outstanding businesses while spending less time on bad ones that are more likely to perform poorly. I will now present this method. This method is divided into 3 steps: Analysis 1.0, Analysis 2.0, and Endless Analysis. In this first video, I will explain the first part of this method. Let's go. The best way to explain my method is by imagining a pyramid. On the wider part, there is every researchable company, and this is where a first approach is made through Analysis 1.0. If the companies are good enough, they move on to the narrower part of the pyramid, where a deeper breakdown is made in Analysis 2.0. From here, only the best of the best will reach the top. These are the ones that we will buy. The endless analysis works as a sideline support for this whole process, where we will constantly reanalyze the stocks we have in our portfolio, the stocks we thought were expensive and the stocks we thought were an A. The Analysis 1.0 methodology is more quantitative and systematized, emphasizing a wide range of ratios and metrics. The focus is to translate the chaos of the company's financial statements into something that makes it easy to understand, like charts or a rating-based system. The goal is also to isolate useful information from not so useful information. Numbers always have a story to tell, and the ratios and metrics of this analysis will help us get acquainted with the company and immediately reveal its strengths and weaknesses. For this group of ratios and metrics, I developed a method called 5 dimensions or 5D. No, I'm not a physicist attempting to connect gravity and electromagnetic force into a yet undiscovered 5th dimension. 5D are 5 key areas of a firm: growth, profitability, solvency, valuation, and dividends. I will attribute a rating to each one of the components of these dimensions, and in the end, I will average everything and get the final rating. It's natural that ratings will vary immensely depending on the industry. We must compare apples to apples and oranges to oranges. We cannot compare a tech company's rating to that of a retail company. A well-run tech company will have higher growth, higher margins, and naturally, a higher valuation multiple than a retail company. These factors must always be present, and we should adapt our mindset to the different industries we are analyzing. You may wonder why I don't also compare the several ratios and metrics with its industry peers. I will, in the Analysis 2.0. To analyze the highest number of companies and keep it efficient and straightforward in the first approach, I only include that comparison in the second analysis after recognizing any value in the company. The additional work wouldn't justify doing it for every company analyzed, as there will be too many unworthy stocks. In Analysis 1.0, I also include a discounted cash flow valuation. This first valuation will have limited assumptions because I am just getting acknowledged with the business. I still don't know the entirety of its strengths and weaknesses, and I still haven't studied the qualitative side of the company's business and industry. These will be done in Analysis 2.0, where I will have much better and informed assumptions. This first approach is used to gauge its current valuation and understand if it's too far off our DCF estimation. Finally, I also use a multiple valuation, a straightforward and rapid method to attribute value to a business. Let's move on and explain my rationale in each section of this Analysis 1.0, starting with 5D. The first dimension I analyze is growth. It's no use justifying the importance of growth in a business, even in well-established markets and companies. It's one key driver of a business that allows greater sustainability and resilience in the market, lower costs due to economies of scale, greater market dominance, greater buying and bargaining power, ability to reduce the threat of competition, ability to survive market fluctuations and downturns, and even the ability to attract the best talented staff. In this dimension, I will analyze the growth in revenues, net income, earnings per share, free cash flows, and free cash flow per share. One might think that net income and EPS growth, and free cash flow per share growth, is the same. However, growth in net income doesn't always translate into growth in EPS. I will elaborate on this further ahead when I discuss shares outstanding and the dilution and buyback concepts. The second dimension is profitability. This is the primary goal of all business ventures. Without profitability, the business will not survive in the long run. That's why measuring a company's profitability is crucial in evaluating the company's value. In this section, I will analyze the evolution of gross, operating, net income, and free cash flow margins, as well as return on equity and return on invested capital progress. Business margins let us understand where a company spends its money to produce its goods or offer its services. It also enables us to grasp if it's running its business with a growing efficiency or if, on the contrary, the trends show that it is running less efficient. If the company advances in my analysis method, the mission in Analysis 2.0 is to understand why it's running less profitable. Return on equity and return on invested capital are excellent indicators of how well a company uses its shareholders' and debtholders' money to generate profits. If a company doesn't make good use of the funds it has available, they certainly don't deserve our money. The third dimension is solvency. Assets are the things businesses own, and the liabilities are what companies owe on those assets. If businesses have too many bills and insufficient assets to pay them, they will fail. In some industries, leverage is an important tool for growth, there's no doubt about it, and I don't demonize debt. However, I don't want overleveraged companies. Instead, I seek solid companies with solid ratios, available liquidity to face short-term obligations, low debt when compared to its profits, cash flows, or capital, and a company that can easily cover its debt and interest payments. For that, the following ratios are analyzed in this dimension: quick ratio, debt to equity, net debt to EBITDA, EBITDA minus capex divided by interest expense, and debt to cash flow. It's time to move on to one key dimension that dominated headlines during 2020 and 2021. 1 year later, prudent investors are outperforming FOMO investors who expected every growth or meme company to reach the moon. That's right, dudes, you already guessed what the fourth dimension is. Valuation. In this dimension, I will analyze ratios like enterprise value to sales, enterprise value to EBITDA, price to free cash flow, price to earnings, forward price to earnings, and price to book value. I cannot define a reasonable value for each one of the ratios because it is always dependent on the company and its industry. Factors such as growth, margins, business model, moats, management quality, new economic trends, or any significant business advantage or disadvantage must be considered. For example, if a company grows 30% per year, has a free cash flow margin of 30%, and has a large moat around its business with no apparent competitors, any investor should be extremely comfortable paying a higher multiple than a standard PE ratio of 15x, right? There are so many things to look up before making an investment decision. But that's my mission: to increase financial literacy in this world so that more people make better financial decisions and prosper. If you are enjoying this method and curious to know more about it, please consider subscribe to the channel, turn the bell on, and hit the like button. To finalize this 5D presentation, we end with the not least important dimension: dividends. This dimension incorporates what investors should expect from the company regarding cash flows returned to shareholders. Here, dividend growth, dividend yield, shares outstanding, and dividend payout ratio are analyzed. It's great to benefit from those steady, growing dividends that compound throughout the years. However, if a company doesn't pay a dividend, it certainly isn't the end of the world. The company may have other priorities, such as reinvesting profits into more growth. One metric that must be analyzed and applied to all businesses is shares outstanding, which refers to the shares available on the open market. This is a critical metric that the average retail investor ignores. However, we can't overlook the power of dilution, which occurs when the company issues new shares and investors own less and less of the pie that is the company. Even if the company increases revenues, profits, and cash flows, investors will get less of each on a per-share basis if the dilution is high enough. Let's look at this example from Meta Platforms. Meta Platforms currently has a $12.91 free cash flow per share and 2,783 million shares outstanding. Assuming the company kept the outstanding shares count at the 2012 level, or 2,166 million shares, and doing some calculations, we would get a free cash flow per share of $16.59, which is 28% higher than the actual result. Assuming the current price to free cash flow of 13.52x, this would result in a price per share of $164.23, obviously 28% more than the current price of the company, $127.82. I don't want to demonize shares issuance. They are helpful, and sometimes management can generate additional returns with that money. I bet that no early Facebook investor regrets their decision today. On the other hand, buyback programs can be fruitful for investors. This is because the circulating supply of shares decreases, increasing each investor's share of the pie. Apple has been a real-life example of buying back its shares. As a result, investors have seen their investment flourish, not only due to the profits growth, business model, and management execution but also due to the shares buyback programs. Apple currently has $6.54 of free cash flow per share, and the total number of shares outstanding is 16,454.98 million. Assuming that it maintained the outstanding shares count at the 2012 level, or 26,469.94 million shares, and didn't engage in any share buyback program, we get a free cash flow per share of $4.06, 38% less than the actual result. Assuming the current price to free cash flow of 22.15x, the price per share would be $90.01. The current price is $145.09. Obviously, the 38% difference is the number of shares that Apple bought during the last 10 years, 38% of the 2012 existing circulating supply. That's massive. These 5 dimensions face every pillar of a company. If a company promises growth, there's a dimension checking if they are effectively growing. If the company promises profitability, there is a dimension analyzing if they are already profitable or on the path to profits. Many bubbles and companies pop due to the lack of solvability. So there is a dimension that will assure that a company is solvable and will remain solvable during difficult times. There's also a dimension that will guarantee that the current valuation is reasonable and not an inflated bubble like we saw in too many companies recently. And finally, there's a dimension that analyzes whether a company is shareholder friendly or simply seeks to sell castles in the air, and new shares that dilute investors. This is one of the most complete and reliable methods out there that will ensure that this community stays on the path to being successful investors. After the 5D is time for the discounted cash flow valuation. DCF valuation finds the present value of the expected cash flows using a discount rate. Generally, the discount rate is the required rate of return for each investor. Mine usually is 12%. 12 percentual points is also the additional returns above market averages for those who subscribe to the Finance Dudes channel and hit the like button. True story. Despite being the favorite tool among investors, DCF has its share of flaws. Starting with the major limitation, too many assumptions. We live in the information era. Never in the history of humankind we've possessed so much data in our hands. Nevertheless, we still can't predict the future. Predicting cash flows is as hard as it gets because we must be right on a variety of variables such as market demand, future trends, the economy's health, new technologies, new competitors, and unforeseen threats and opportunities. I will never be exactly right, but I can be kind of right, or right with a margin of safety to be wrong. You must also remember that what is a reasonable assumption for me may not be a good assumption for you because you may have a different opinion. I can be wrong and you can be wrong. That's why by creating this community I expect we combine our strengths to produce first-class assumptions so we can all prosper together. In this DCF valuation, I will consider 5 scenarios. Base case, bull case, bear case, extreme bull case, and extreme bear case. I will begin by developing the assumptions for the base case scenario. Its past performance figures and Wall Street analysts' forecasts will be the primary source to justify the assumptions I'll use. Once these first scenario assumptions are established, I will move on to the remaining scenarios, either increasing or decreasing the assumptions to be more optimist or pessimist respectively. Naturally, not all scenarios will have the same probability of occurring. The base case scenario will have the highest likelihood, whereas the extreme cases will have negligible chances. You should keep in mind that these probabilities are estimates, not real probabilities. In the end, each scenario is weighted by its probability, yielding the final price target. I should point out that all these assumptions are made to give me a general idea of the range of prices I should be paying and scenarios I should be comfortable investing in, not an exact price. It's time to talk about what kind of assumptions I make. Cash flow growth is the first, and second, because it is divided into 2 groups. First, the growth in years 1 to 5 of our forecast, and then, growth in years 6 to 10. I believe splitting into 2 blocks is preferable to assuming the same growth rate for 10 years. The following assumption is regarding shares buyback or dilution. As explained before, this is an essential metric that frequently changes everything. I call it a silent return killer. However, you are safe with me. The free cash flow margin is the 4th assumption. Free cash flow margin measures how efficiently a company converts sales into cash. To end the assumptions presentation, I couldn't skip price to free cash flow multiple. This multiple measures what the market will pay for a business at the end of the 10-year forecast. Although markets are now in a much better shape in terms of valuation when compared to COVID bubble, valuations these days aren't a concern for many investors. Some believe that a 100x price to free cash flow ratio is sustainable forever and the market will always be willing to pay it. Well, I think that's insane. I'm not saying that a company with a price to free cash flow of 100x is too expensive today. If the company is expected to have insane growth ahead and continuously improve its margins in the future, is in a great industry, has a significant moat, and has a great management team, I don't see a problem with paying that multiple today. A different thing is assuming that the market will continue to pay the same 100x ratio 10 years from now. In the long run, all companies will trend towards the range of 10 to 25x price to free cash flow ratio. Fortunately, we come again to a time where the smartest investors aren't considered the dumb ones just because they didn't invest in the latest crypto scam or the latest stonk pump and dump scam. Zero interest rates was a tide that lifted all boats and now we are seeing who was swimming naked. Investing takes a lot of effort and time to do it right. Charlie Munger, when asked why does nobody is able to replicate what Buffett and Munger do, he replied, because nobody wants to get rich slow. One of the hardest truths is that success takes time. I don't want to be a Jim Cramer or other YouTubers of the world that tell you to buy a stock just because they like it and bring views to the channel. It takes a lot more than liking a stock to be a good investor and successfully win in the long run. I have a commitment to you and I'd rather not having any views in my channel than scamming you all to go buy the latest pump and dump scheme. Finally, the last step of this analysis 1.0 is to apply the multiple valuation method. In this method, it is estimated what price a company should have if it traded with its 5-year and 10-year multiples. It's a great and easy way to attribute value to the business. Markets are frequently irrational and often overreact to news, which is fantastic for a long-term investor like us since we can take advantage of short-term irrationality. In this first analysis, we just put our feet into the water to assess the company's worthiness. It's not used to make investment decisions, instead, it is used to separate good businesses from bad, value creators from value destroyers. I only want to spend additional time and energy on excellent and valuable stocks. For those stocks, we now have analysis 2.0. Make sure you watch the 2 other videos of the Finance Dude's method, you can find them on the top right. Thank you for watching, and if you identify yourself with this channel and are interested in learning more and having access to the best analysis process out there, please consider following the dude in social media, subscribing to the channel, turning the bell on, hitting the like button, and sharing with your friends and family who would benefit from following this channel. You can also increase your support by subscribing to the Patreon page. The link is in the description. It would help the channel a lot and the dude would be forever grateful to you. This project is a massive enterprise, but with your help, we will reach people that really need this. Together, we can transform the world by giving people proper tools, which should have been given to us all at school rather than kept hidden just for the elites. We are in this together, dudes. Let's go.